Good morning and welcome to another edition of the Main Management Weekly Market Note for December 5th. I am Alex Varner, head of research here alongside
James Maxwell, SVP of Research.
Hope everybody had a great weekend. Let's get into it. As a reminder, our ETF offerings, BuyRight, TMAT, SECT, and INTL all available. On the performance side of things for the week, the sectors were pretty mixed. Utilities had a rough week, down 4.4. While tech was up 2.4 for the highest performer of the trailing week. And on the broad index side of things, commodities led the way up 1.6, while bonds were down 0.8%. Part of that is on kind of, rate expectations changing. We had the FOMC meeting this week, so that's a big potential change. It is forecasted to be 25 basis point cut. On the recession dashboard, not a ton of change here from November over to the first week of December. We're getting that data back out now, which is nice. But I think from what we've seen so far, kind of high level employment picture continues to moderate. The inflation picture is not hugely moving one way or another. We touch on that a little bit in here as well. On the core PCE, that is the personal consumption expenditures, that is the Fed's preferred inflation measure. That September, we're only 3 months delayed, but it was up 0.20%, in line with expectations, the third decelerating monthly reading in a row, and year over year inched down to 2.83. So that basically gives the Fed the green light here, I think, to cut this week. Probability for the rate cuts up at like 87% for one cut. So I think that's pretty much baked in at this point. The core goods, something worth noting is goods and services on the right there. You see the core goods, and that's really accelerated. That's up to 1.2% year over year. That's off the left axis there, which if you take out COVID, that's one of the fastest paces in 30 years. So you're definitely seeing this tariffs show up there. The good news is that services have continued to decline. So you do get some kind of offsetting balances there. But, when folks are paying for goods, it certainly kind of shows up a little bit more obviously.
This is something we flagged pretty early on during a lot of the tariff announcements, is that typically what you see as tariffs, they're kind of seen more as like a tax or like a consumption tax, where it's not like you're all of a sudden spending more money overall. It's more like the mix shift of what you're spending is moving around, where you're going to spend more on those goods and less on those services. So that's kind of influencing those respective price indexes. So the overall kind of headline number remains relatively the same.
Because you have those two kind of opposing forces almost. And it's, the old saying is what's the best cure for high prices? High prices. People move out of the high box stuff, high price stuff, and substitutes or, move away and or don't spend on certain items. On the income and spending side of things, spending kind of came in a little bit more muted. It was up 0.31% month over month. You saw August revised downward to 0.5 from 0.6, so not great there. Year ticked down to 4.99. That's the slowest increase since January of 24. So some moderation on the spending side. I think for more real, and again, this is back in September. So the more real-time stuff has shown that companies in their individual guidance and reports and kind of anecdotes have said that spending is holding up reasonably well. And again, this is still 5% year-over-year increase. It's important to remember that pre-COVID, we were at 5.3, but you can see over there in 2019 going into it, we were ramping from 3 to 5. So this is still solidly, in line with pre-pandemic numbers. On the right, incomes were up 0.36% month over month. That was slightly ahead of forecasts. And the year-over-year figures basically unchanged at 5.16. So you're getting a little softness in the spending, but real incomes continue to outpace inflation, which again means real purchasing power for consumers, and that's a good thing. And I think this also speaks to kind of the sentiment that's been overhanging. We touch on sentiment a little bit later on the business side of things, but the consumer sentiment numbers this whole year have been pretty rough. And I think that makes sense with kind of people pulling back a little bit on the spending, being a little bit less robust, I guess, for lack of a better term.
It's moderating. I know that there's been some anecdotes from like the holiday spending being pretty strong. Especially this kind of last earnings season, even the kind of lower income consumer, which has had a lot of focus, has been fine. I think is kind of the general consensus.
You haven't seen any sort of dramatic. It's kind of marginal up or down, a bit here and there. On the industrial production side, with the kind of back to the hard data we're getting, again, September data is getting in, the last week of or first week of December. But basically, we didn't miss much while this is out. That's kind of the easy way to put it. Industrial production was up 0.1. Manufacturing input was basically flat, down 0.02. and the year over year, both are kind of accelerating, which is good to see. Industrial production is up 1.6. It's the fastest since September of 2022. And manufacturing output is up 175. That's the best since April of 22. So kind of seeing these steady year over year. And again, the comps are kind of easy at this
Yep.
point. I think you're not seeing a whole lot here, but this is something that we're looking here where this is kind of ripe for, or seems like low hanging fruit for kind of AI automation. What's the word? Productivity
Mhm.
increases, where you can see on the capacity utilization on the left there, that's been grinding lower since basically 2022. It's now down to 75.9% for total, and manufacturing at 75.5. And I think part of this is, it's big, easy productivity gains where
Yep.
I mean, you think about machinery, what once took 10,000 feet in a warehouse to produce a widget X
Yep.
can now be done in 3,000 square feet. So you
Yep.
have the 7,000 square feet sitting empty and you're able to produce more. So I think that's part of the capacity utilization there is it's like maybe use less of the space and ability hub, but that doesn't necessarily mean, as we've seen, the output is
Mhm.
still moving higher.
Mhm.
So you're seeing kind of two pieces there that are, make sense when you tie that productivity piece into it. And then on the right, we're showing the high-tech components for industrial production, basically up and to the right. Other than communications equipment, which is clearly very cyclical, that's that green light that is just these big sweeping up and down. There's got to be something else that we need to look at there for some reason. But the point is the computers, the peripherals, the semiconductors, the business equipment, the average, that stuff is all up and to the right on a year over year. And that's good to see,
Yep.
especially as we kind of continue with this AI
Yep.
CapEx build out play. The demand there is clearly strong. On the payroll side of things, so we got a little bit of inflation earlier in the presentation or on the deck. Now you get the payrolls, which is the employment side of thing. They were down 31,000 in
Mhm.
November per ADP, well below forecast for a 10,000 person increase. The problem here is the decline was driven entirely by small businesses, which shed 120,000 jobs. It's the biggest monthly decline since COVID. Over the last 4 months, they've dropped 222,000 jobs and are now negative on a year over year basis at minus 0.24%, which is the first negative reading since March of 21. The problem there is that small firms account for over 43% of total employment. So you don't like to see weakness
Yep.
in the majority, of businesses as far as kind of the numbers of people are concerned. Large firms are up 39K, their sixth straight gain, while medium firms added 51K. That's the first up and after 3 down months. On a year-over-year basis, things are trending lower, and again, that's weighed on by that small
Yep.
business. And this really kind of, in our mind, combined with that inflation data, makes the Fed's case for a
Yeah.
cut this week pretty easy.
It's funny to see, I mean, this and then tying in with the PCE earlier. Clearly, inflation is kind of just marching along fine at
Yeah.
like high twos, and employment. You can criticize the quality of ADP or the ADP release, but like kind of directionally, it's telling you that it's weaker than it was,
Yeah.
6 months ago. It's funny that you know, just a couple of weeks ago, it was questionable whether the Fed would cut at all, given this kind of backdrop. And then even with this cut that is expected on Wednesday, it's expected to be kind of like a hawkish cut,
Yeah.
or like the narrative around it's going to be, okay, maybe we'll pause for now.
Yeah.
I don't know. I don't know if you have
No,
thoughts on
it's
that.
interesting. I mean, there's just seeing more kind of discussion come into basically all the pieces I've read in the last couple of days have been, all right, December's kind of baked in. We're
Yep.
now going to see what they say about January. And
Yeah.
that's really going to be the important part is the language they use in the statement and the presser this week, is that changed, or is that going to be more hawkish, more dovish? You're going to get some dissents. They're expecting one or two formal dissents,
Mhm.
4 or 5 kind of soft dissents through the voting. So however you want to kind of skin that cat, but I think it's certainly directionally this is not trending the way they want.
Yep.
And I think they've clearly indicated they're focused on the employment market or the labor market more so than inflation.
Yep.
To what James just said is inflation's kind of running along, not
Yep.
really moving too much up or down. On the another data point, this is again the private data points. These kept coming out during the government shutdown, but Challenger, Gray, and Christmas released their monthly job cuts, and they good news is they retreated to 71,000 in November from that massive 153,000 in October, which kind of spooked people. But they're still up 24% year over year. Hires were at 9,000, which is just pretty puny. You can see on the bottom right there, those are the hires by month. They've been on average 60% below their historical averages, while cuts have been 70% above theirs. So you've had, just consistently stronger cuts, consistently lower hiring. And the result is that now we're at almost 1.2 million cuts announced for the year versus basically 500,000 hires. And this, it looks like, given the historical numbers from December, this is going to be the first year where cuts outpace hires.
Yep.
Since they have data. And that 1.2 million, even with another month to go outside of COVID, would be the highest full year since 2009. And it's been tracking that way for multiple months now. So,
Yep.
The kind of, and again, these are announcements, they aren't fruition. It would be interesting, I think, if we had a way to kind of say, okay, Verizon announced 15,000 cuts. How many of those cuts actually came to fruition?
Yep.
Because that, the headline is usually worse than the actual reality that occurs. But nonetheless, again, this is kind of like ADP where directionally, that's how you're reading this. You don't take 1 month with too much importance. You say, all right, basically, what's kind of the trend going on here, and don't quibble too much about the kind of minutia of like, oh, the month.
It's this number versus 10 more versus, it's directionally, it's the same story.
And then, on the industries, and again, we do look through the industries directionally, what's happening. And you saw tech was kind of at the top or second to the top behind government as far as cuts go. But tech had the most net hires, actually. And that's something that you don't hear about in this report is they're like, oh, tech is cutting. And you're like, well, actually, they announced 100,000 more hires than cuts, but they kind of sweep that under the rug because it's the job cut report. Whereas government had negative 300,000. So that's more cuts than hires. 308,000 netted against only 13,678 hires. Again, this goes back to Doge. We're still talking about that. But basically, of those 294,000 of those came in February and March, and it was Doge. That was the reason cited. You can see in the top right there. Basically, those cuts all came earlier in the year. 280,000 of those 294 were in February and March. And then in the last 2 months, there have been precisely 0 cuts attributed to Doge. So they basically came and gone. Like a year ago, you could have just not worried about it. Market conditions is the second most highly cited reason for cuts at basically 250,000. And then worth noting that AI, artificial intelligence, wasn't on the radar for the first 5, 6, 7 months of this year. And then August, it kind of popped on to the reasons that companies were citing, and it finished 5th overall with 55,000 cuts, call it. So that's something worth noting going forward. And I think part of that is, is the low-hanging fruit of these kind of entry-level jobs. And you see some of that play out in tech, but there are other industries as well where it's kind of, you see, ads for like, replace your receptionist with an AI person. They're checking in, you're checking in on a tablet with a little talking head. Who knows how that continues? But that's also the sort of thing where it's a one-time replacement. You don't repeatedly fire your receptionist. You replace one person with AI, and then it's kind of like the one-time effects of the tariffs on the other side, where then it's done and that equilibrium is shifted. So, we'll see what happens there with December, but probably more cuts than hires for the full year. We got some hard data as well. The November manufacturing PMIs on the left, that's for the kind of the global major players. Only Japan improved on the manufacturing side up to 48.7. The US ticked down, but kind of still remains at the top of the pile. China's back in contraction at 40, just barely at 49.9. JPM global index is down to 50.5, and Eurozone's down to 49.5. Services were a little more mixed. I guess you could say more positive since the manufacturing more negative. But kind of the big one there is just Europe is up to 53.6. That's its best reading since May of 2023. So starting to see some signs of life perhaps in the Europe services. And the US is still kind of near the top at 54.1. Then within the US on the manufacturing side of things, the headline indices were pretty negative. You saw as we said, the S&P figure tick down. ISM is down at 48.2. That's the 9th month in a row in contraction. And then Chicago PMI also been, it covers a smaller region, so it's more volatile, but that dropped 7.5 points to 36.3. It's the biggest monthly decline since December of 23, so it's a pretty big fall off. And then on the right, we show the ISM manufacturing PMI kind of underlying indices, and prices, inventories, and production were up while new orders and employment declined. And then, interestingly, the report says some of the manufacturers are starting to link layoffs to tariffs, which isn't great. But that's why that price index has been kind of up. So we'll see what that continues to be. On the kind of sentiment side, the RCM, TIPP, it's a mouthful there. Economic optimism index rebounded to 47.9, better than expectations for a 44.1 reading. You can see on the right there, the month-over-month gains were the most solid in, over a year, basically a year. Personal financial outlook's at 54. Support for federal policies is back up to 45, spot 4. But maybe this kind of sets the tone for some of these sentiment indices to start maybe moving a little bit higher in December. Sometimes you get a seasonal effect where people are like, "Oh, it's the holidays, we're
Yep.
happy." They tend to
Yep.
respond a little bit more positively
Hmm.
to these readings. So we'll see. But you got to start somewhere, and this is as good a start as any for the time being on this side of things. So I think that kind of wraps it up. In summary, core PCE in line with forecasts at 2.8 year over year, kind of supporting the case for a Fed rate cut this week. Same for the payroll data, the job cut announcements and ADPs, kind of setting the tone and making the Fed's case pretty easy. Industrial production and manufacturing output September didn't miss a whole lot. PMI is mixed, kind of more up than down, or sorry, more down than up on manufacturing. The services were a little bit more mixed, and then we're starting to see maybe some signs of sentiment starting to turn again. 1 month does not a trend make, but you got to start somewhere. This week we get the big news is FOMC on Wednesday, but we get JOLTS on Tuesday and the productivity unit labor cost Tuesday, Wednesday, and then inflationary, we get the PPI data on Thursday that we haven't had for quite a while. So thank you for joining us again. Hope you found this informative and have a great rest of your day.
Thank you.